Yes, Alibaba is uninvestable. You heard that right. Oh wait, my connection is getting a little bit shaky here. So are we underweight or are we overweight onto Alibaba? You know what? We prepare both the bullish and bearish report of these Chinese securities and then just release either of them that matches the price movement thereafter. Stonks. Smashing the like button is equally stonks, by the way. True story, according to people familiar with the matter, of course, I do know people in the industry and they did share their experiences with me on how they actually saw the back-end research team prepare two sets of different slide decks or research report and publish them post-earnings depending on how the share price actually reacted. So how trustworthy is this story? I let you be the judge. Now, if it's some random mom and pop bank or even a hedge fund that made such a remark, investors will simply just brush it off. But it was our dear analyst from JPMorgan, one of the top international banks out there, that made the call on the 14th of March, downgrading Alibaba to underweight and lowering their price target to $65. So the call couldn't have come at a better timing, because Alibaba indeed nosedived the following day on the 15th of March to the lows of $73. And right after, I think the senior officials of the CCP couldn't take it anymore, and they essentially have gotten Vice Premier Liu He to essentially pledge support for both the economy and its capital markets, sending all China stocks soaring back again on the 16th of March. And Alibaba went straight back up to $105. So I don't know whether they were in cahoots, but it definitely seemed highly suspicious. Even if you wanted to manipulate the markets or even attempt to, you can at least try to be a little bit more discreet. So on that same note, in my previous video covering StashAway, which is essentially a robo-advisory platform in Singapore, they slashed their entire Chinese equity exposure during the meltdown on the 14th of March. So looking back though, could that period of time suggest the bottoming out of all Chinese securities because everyone seemed to have given up hope on them? We can only look forward to what transpires next. Besides, it's not as if Alibaba has recovered to a significant extent, as it's also currently flirting within the $80 to $90 range. Now, here comes the ironic part. Not too long ago, JPMorgan issued a new range of price targets for different Chinese securities across the board, from Alibaba to Baidu to JD to Tencent. And our target for Alibaba is back at $130 again. So in the short span of less than 2 months, I wonder what had materially changed for them to have this 180-degree shift in perspective. Or maybe, like I speculated earlier, they already had two theses to begin with and just echo whichever made more sense at that point in time. Who knows? So it will be even more interesting if StashAway decides to add back their Chinese exposure into their portfolio again. So I'm looking forward to that. So I've actually gotten my hands on the full updated JPMorgan report. So if you want me to run through the analyst report and provide my opinions on it, remember to smash the like button and also comment part 2 in the comment section down below on what you look forward in that report specifically. So the report is over 100 pages, but I'll probably just zoom into the portion specifically to Alibaba and maybe certain e-commerce trends or certain industry trends that concerns us as shareholders. So who cares about the rest of Chinese big tech? Oh wait, I do, because I do have K-Web exposure, but I know most of you don't. So comment below on how detailed I should go into the next episode with this entire JPMorgan saga. So anyhow, I think the most hilarious thing that actually came out from this Prata flipping freak event was that JPMorgan's uninvestable call on China was actually published in error. Yes, you heard it right, published in error. So maybe you can actually consider hiring me. I'll make sure that I won't call China uninvestable. Jokes aside, for my foreign viewers, roti prata is an Indian flatbread dish that is prepared by flipping the dough exactly 69 times. So I think they can consider setting up a prata franchise soon. Anyhow, of course it's according to people familiar with the matter. They claim that their uninvestable call was never meant to see the light of the day. So the editorial staff in charge of JP asked for uninvestable to be removed from 28 of the reports penned by the analyst Alex Yao and his team before the research report was being published. While the word was cut from most of its report, according to the editorial head, In some cases, it was replaced with unattractive instead. So the term uninvestable still appeared in the published version on 4 separate accounts. So in one particular instance, and I quote, "As risk management becomes the most important consideration among global investors in relation to their China investment strategy, as they price in China's geopolitical risks, we view that China Internet is uninvestable on a 6 to 12 month view." Clearly, the 6 to 12 month view was shortened to 2 months instead, because it seems like everything is either adjusted upwards to neutral or even overweight. So on a side note, for what it's worth, because I don't know how much their price target is worth anymore, just for your own reference, JPMorgan actually set Alibaba to overweight while JD to a neutral setting. In another universe for consideration, JPMorgan is definitely stuck between a rock and a hard place. So a global bank like JPMorgan is trying very hard to ramp up their businesses in China and to improve the relationships there. Because obviously, the amount of potential new businesses over there will make any shareholders salivate. Even though I know the world still think that we can do without China. The caveat is, they still have to provide client access to quote-unquote candid research as what they pride themselves on. So what actually happened during this price-cutting exercise was that Alex Yao and his team actually re-rated the US-listed Kingsoft Cloud Holdings by more than half. So it triggered a flurry of downgrades by other rival banks as well throughout the entire month of March. And you know what happened as a result? JPMorgan was then removed by the way, as the most senior underwriter for Kingsoft's Cloud Holdings planned Hong Kong stock offering. So what does that mean? It means that one of the business plans went haywire. So how much was it affected by the price target cut? Probably 100%. So moving forward, I think there will be more of such conflicts that banks have to manage. On one hand, they want to manage the relationships with these different conglomerates. On the other, how are they going to manage this kind of investment sentiments and to provide quote-unquote candid research? I don't know. Anyway, I think there are 2 key lessons we can take away from this entire debacle. Number 1, never trust anyone else other than yourself. Yes, including me. Don't trust me. It's extremely tricky to navigate, especially so in the entire finance world. So I know that it feels good when you cross-reference your analysis with various bulge bracket banks' view, or more importantly, some bloggers or finance YouTubers, etc. and observe that, hey, you might share the same train of thought. But it doesn't mean anything because, as you have witnessed, things can just change within the blink of an eye. So I can be overweight today and I'll be underweight tomorrow, depending on the circumstances. Of course, I'm talking about securities and not my own weight. Furthermore, the price targets being dished out by these investment banks usually comprise of their short-term view of the market. Likewise, it's termed as 6 to 12 month short-term view. So just don't get too caught up in chasing these different price targets. So if it doesn't affect your decision at all, meaning to say that if JPMorgan today says that Alibaba has a price target of $20 and you're not selling, then why are you even still monitoring them and their different price targets? Number 2, the world works within an incentive structure. For banks, for individuals, it is always critical to appreciate the inherent incentive structure before making any forms of judgment or decision based on this so-called quote-unquote advice or research or reference. So if there is an inherent conflict of interest, then you can't take anything seriously because your interests are definitely not aligned. So like always, everyone will tell you to do your own due diligence or research, but I understand the need for social proofing and seeking for a confirmation bias. So remember that no one cares about your money more than you do. Leave in the comment section down below what you want to see in the JPM analyst report. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!